Good morning to you both. And Jonathan, I will start right there with that question. Are there opportunities in this market, even as we're hearing folks like Paul Tudor Jones and Ken Griffin, and then, of course, that string of sound that David just played from Milken, really raising the cautious flags, to say the very least, around the market conditions right now?
Yeah, I mean, first of all, the market has corrected an enormous amount. Year to date, earnings expectations are up like 5 to 6% for the market, and multiples have come down dramatically. So the market is much healthier now than it was at the beginning of the year. And you also have to think about this. The Fed is so far behind the curve. We're expected to see an economy with 9% nominal GDP. And even if the Fed does what everyone's talking about, you're still going to have 1 to 2% average Fed funds this year. So you have a very, very supportive environment with stocks cheap. So I think this inflation risk over the near term is overdone. And I think the downside in the market has already been recognized.
Omar, how do you see it? Do you think the bottom is in?
Well, if we look at the current facts of where we are in the cycle and the fact that, yes, the Fed is in the process of liftoff, with 50 basis points completely priced into the market. And actually the June meeting with another 50 basis points pretty much baked into what the expectation is. I would probably say the stability of what we see now until then is probably going to be in this range. However, if we look back at history, anytime that we see these aggressive, high processes, usually we end up in a recession. And when you combine that with the fact that we have seen, significant level of inflation that, in many cases it may have picked, but it's still not see any signs of big, drops. I would probably think that there's still a lot of downside that still need to happen. Now, what is important to see is that the sentiment across investors and consumers is still very negative. And that also just puts a little bit more pressure onto what we may have to see throughout the summer. So I would expect that, we haven't seen the final capitulation, and there's still, probably a little more pain before we can actually get to a more constructive area, especially because of deceleration of the economy and earnings.
Okay, so question for both of you, but Omar, I'm going to start with you, just given how cautious you sound right there. How do investors position themselves right now?
Well, there's a few things that, we encourage investors to do. Number one is rebalancing. We have been in an amazing bull market for a decade, and in many cases, a significant portion of investors are always looking for opportunities to find ways to be tax efficient, to be able to rebalance this risk. And this is something that we encourage investors to do all the time. Rebalance, rebalance, rebalance. We're going to see more of these periods of volatility to maintain diversification and continue to keep, a well, solid portfolio based on their investment objectives. The second piece is look at what we're going to see down the road. And as I said earlier, if inflation is something that is not going to be temporary and still going to be with us, with the Fed is trying to just combat it, look for opportunities in commodities, in real estate, in areas that allows them to basically reposition for those environments, as well as, when we expect to see the yield curve to be a little higher. So there's areas like financials and others that will probably still benefit from what we may see down the road.